Today, we dive into VSE Corporation, an aerospace and defense firm that's, well, certainly captured market attention with an aggressive and seemingly successful corporate transformation.
It certainly has.
The story here, I think, is one of decisive strategic focus. VSE has entirely pivoted, shedding its diversified services past to become a pure play entity. It's dedicated to the high-margin aviation aftermarket. And the results? Well, they seem pretty undeniable, leading to a soaring stock price and very bullish analyst targets.
And that pivot, as you call it, has created a massive and, I would argue, highly unstable gap. We are seeing just an extreme divergence between that market optimism, which is frankly overwhelming, and what traditional calculations of intrinsic value suggest VSE is actually worth.
Does VSE Corporation's strategic shift and proven execution fully justify its high current market price and those corresponding growth valuation multiples? Or, as you suggest, does that wide intrinsic value gap scream significant overvaluation and, well, inevitable risk? I lean towards the view that the transformation warrants the premium.
And I come at it from a different angle. While sure, acknowledging the strategic success, I maintain that based purely on quantifiable financial metrics and the inherent risk tied to future execution, the stock is fundamentally overvalued. It poses a serious margin of safety concern for investors right now.
Okay, but we really have to stop looking at VSE as the company it was even just 2 years ago. I mean, this is a deliberate strategic overhaul. Management has effectively exited the low-margin, capital-intensive segments, most notably completing the divestiture of the non-core fleet segment in 2025. The focus now is laser-targeted on aviation, parts distribution, and high-value MRO services, maintenance, repair, and overhaul.
But it definitely came at a high cost. And, the market seems to have already factored in that clarity several times over in the price.
But the execution validates the valuation, doesn't it? The integration of prior acquisitions, Kellstrom and Turbine Weld, that was ahead of schedule. It set the stage for the crucial, $350 million Aero 3 deal in Q3 2025. This focus translated directly to the bottom line. Record revenues and adjusted EBITDA in Q2 and Q3 of 2025, forcing management to raise full-year guidance repeatedly. The market has rewarded this growth, driving the stock up, over 90% year-to-date, with consensus analyst targets averaging nearly $190 a share.
But let's anchor ourselves in the financials for a moment. The current price, around $180.97, it just exists in a different reality than most intrinsic value models. I mean, Guru Focus pegs the intrinsic value estimate as low as $73.71. Simply Wall Street's discounted cash flow, the gold standard for valuing growth stories reliant on future synergies, estimates the value at only $90.47. Even their most generous calculation, the two-stage free cash flow model, tops out at $152. This suggests the potential overvaluation exceeding 80%.
Okay, but don't you think those static DCF models just fail to adequately capture the accelerating synergy capture and the proprietary high-margin nature of these new pure-play revenue streams? They feel like backward-looking measurements applied to what is fundamentally a forward-looking story.
That's a compelling argument, I'll give you that, but then we absolutely must address the sheer extremity of those forward-looking metrics you're implicitly relying on. We're talking about a trailing 12 months price-to-earnings ratio of, 139.47, and an enterprise value to EBITDA of nearly 30 times. I mean, even if we look forward and use the forward PE of, say, 42.48, we still run into serious issues when comparing it to the expected growth.
And this leads directly, I think, to our core point of disagreement, whether these extreme valuation multiples are simply the cost of admission for high-quality, high-growth aviation pure-play revenue. Is that the price you pay?
Exactly. Let's look at the PEG ratio, which for listeners is essentially the price we pay for each unit of expected growth. VSE's PEG sits at an incredibly high 7.58. That's based on an expected 5-year EPS growth of about 18.4%. Now, for a healthy, reasonably priced growth stock, you typically want to peg closer to 1, maybe 2. A 7.58 suggests the market is pricing in absolute perfection. It's anticipating that VSE will not only hit that 18% growth, but dramatically exceed it, all while margins expand far faster than currently projected. That's a tall order.
The historical PE is, I'd argue, almost irrelevant, precisely because the strategic pivot involves shedding those low-margin legacy obligations. The current high multiples reflect the market correctly anticipating the margin expansion. That expansion comes from these integrated acquisitions and the new OEM programs like those recently announced with Eaton and Bridgestone. We're seeing immediate synergy realization because VSE is capturing market share in a frankly fragmented parts distribution sector, often using proprietary channels or tooling. The record Q2 results, I think, confirm that this margin expansion is happening now, validating that forward-looking optimism embedded in the price.
But the quality of that margin expansion has to be viewed through the lens of capital intensity, doesn't it? You rely on momentum, sure, but that massive stock return demands perfect capital allocation going forward. And this brings us right back to the historical cash generation picture, which isn't quite as rosy.
Why focus so much on historical cash flow when the balance sheet stability looks so strong right now? Look at the liquidity. A current ratio of 3.94 and a quick ratio of 1.41. That signals pretty robust short-term financial health. Furthermore, the company has maintained a reasonable debt-to-equity ratio of 0.40. I mean, this isn't a company leveraging itself into oblivion. They executed a public stock offering to fund the $350 million Aero 3 acquisition, demonstrating, I think, disciplined capital management aimed at maintaining financial flexibility while still growing aggressively.
I agree. The low debt-to-equity ratio offers flexibility. That's fair. However, liquidity doesn't pay for long-term growth. Only free cash flow really does that. So I would focus instead on the historical average negative free cash flow margin over the last 5 years. That's concerning. Significant acquisitions like Aero 3, they're the equivalent of high-stakes specialized surgery in the supply chain. They require flawless, absolutely flawless cost synergy capture to justify that massive investment.
And management has proven they can execute complex integrations ahead of schedule, though. They have a track record now.
Okay, but if integration falters, even slightly, or if the projected revenue synergies are delayed, even by a quarter or two, the persistent negative FCF generation, combined with the high reinvestment demands needed to sustain that projected 18% growth, could severely constrain the company. They'd likely be forced to raise capital again, diluting shareholders, or potentially accumulating debt. That would make that comfortable 0.40 debt to equity look very different, very quickly. You're pricing the growth as if it's self-sustaining, but historically it has required external capital injections.
But the risk profile is structurally better now, though. Wouldn't you agree? The new pure play focus dramatically reduces exposure to political risks, contract renewal risks, things associated with the old low-margin segments like the USPS contracts. They are focused now on global MRO, which involves extending the lifespan of critical aviation assets. This focused, global approach, I think, inherently lowers the operational risk compared to the prior diversified structure.
Essentially, you've merely traded general diversification risk for highly concentrated execution risk, while MRO, maintenance, repair, and overhaul, is certainly a growing market driven by aging fleets. This is exactly where the strategic vulnerability now lies.
How so? Explain that.
Well, by becoming a pure play, VSE is now acutely sensitive to two major factors, as I see it. First, the success hinges entirely on M&A integration. If there are culture clashes, technological integration failures, or, supply chain disruptions in combining these specialized parts businesses, the synergy capture just disappears or gets delayed significantly. Second, while the aging fleet is driving MRO demand now, technological evolution in newer engine platforms can fundamentally shift the market down the road. If VSE's proprietary parts distribution is tied too heavily to specific older engine models, they face a kind of technological obsolescence risk that a more diversified company might be able to shrug off more easily.
Okay, but surely they are actively managing that vulnerability through deep OEM partnerships. That secures their position in future programs. The announced agreements with Eaton and Bridgestone are evidence, I think, of lock-in and long-term high-value contracts that extend beyond just relying solely on legacy assets. They seem to be shifting from simply repairing old parts to providing essential contracted services across the entire life cycle.
They are certainly attempting that shift, yes. but that requires continued massive capital commitment. And a company valued at a PANG of 758 simply has no room for error in these high-stakes integrations and transitions. Zero margin for error priced in.
So ultimately, I see VSE as a successful turnaround story. It's transitioned decisively into a high-growth, high-margin aviation MRO provider. The market valuation, in my view, is a forward-looking acknowledgement of record performance, successful acquisitions, and that aggressive growth potential that, frankly, backward-looking intrinsic value models just cannot fully capture. We have to recognize that the transformation is being validated by the operating results we're seeing right now.
And I maintain that the successful turnaround, while real, has been priced in several times over. The aggressive growth blueprint must be viewed through the lens of these extreme valuation metrics and the significant, unavoidable execution risk tied to complex integrations in a very specialized industry. The fundamental disparity between the stock price, close to $181, and the estimated intrinsic value, ranging from maybe $74 to $152 at the high end, implies a substantial margin of safety concern for any investor relying on disciplined financial valuation. The growth is real, I concede that, but the price demands perfection.